Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 25th of 2023. Well, let's start the chart pack off this week with a discussion of the economy, and then we'll dig into what you're looking at here, which is the number of consecutive months of the decline in the index for leading economic indicators, or LEI. So the chatter as it is evolving here in the economy is that, the question is building on whether or not we're actually going to have a recession. And there seems to be a little bit more confidence building because the market seems to be holding up and the data is not ultimately catastrophic, or at least not yet. And so, there's this growing sentiment out there that, we're going to have the soft landing and the Fed's going to stop raising rates and things will be just fine. Well, it's hard to ignore the data, and this is why looking at a chart like this, that you have to prepare for what you don't know. And history is a guide here. It's not the absolute, and you can't say, well, past is prologue, but this chart does a really good job of kind of foreshadowing recessions. You see here in a data series that goes back to 1961. And these very notable spikes, 1973 and 2008, which represent, the longest consecutive number of months of decline in the LEI that we've seen since 1961. And we're at 14 months right now, which eclipses all but those two very pronounced periods. And see in these gray bars that are superimposed on this chart, those represent recessions. And so, again, it's hard to ignore the data when it's telling you that you have perhaps a recession on the front end. And that's not to say it's going to be a hard recession, not going to, necessarily say that it's going to be a soft recession, but it's just telling you that this is something that you should be preparing for in portfolios and not get caught up in the rhetoric, because the data is very telling here. And here's another data series that you just simply can't ignore if you're, trying to, read that crystal ball, what the future holds. And again, you can't just go off rhetoric. You have to look at the data, and you have to respect what the data is telling you. And this is a chart going back to 1996 of global money supply. And again, there's another data series that just shows you U.S. money supply, but the trends are exactly the same. Here you can see the whiplash effect of the pandemic, which is obviously very rare, but then you have a huge infusion of liquidity, as you can see here, and then as you would expect, you get a whiplash effect, and so that liquidity gets pulled away, and that's where we're at right now. And you can see, both at the U.S. level and at the global level here, you can see about -3 to 4% growth, and when we've had periods where we have had, or where we've seen negative or very large contractions in money supply, that you've typically, that those periods typically correspond with recession. And of course, when you average U.S., China, and these other areas together, you're almost never, ever going to have a negative money supply growth. And in fact, this is the only one in this time series that's actually negative. But you have seen it before a couple of times on the U.S. data. But, clearly each time you've seen that contraction, it has foreshadowed a recession. Now we'll talk about the housing market. And so, what we saw in the most recent set of data, the median home prices were down 3.1% in May year over year for a median home price of about $396,000. Now that represents the biggest drop that we've seen since December of 2011. And you can see in this data here, we've got existing home sales, tracking below their decade-long trend here, and you can kind of maybe back out the anomaly that was 2020 and then 2021, and then just kind of look back over the last decade, and you can see that we're below that trend, and you can also see the price trend. So we've had a fairly strong period of price appreciation, as we've discussed over the last couple of years. But then that has decelerated on a fairly consistent basis over the last 9 months to the point now that we finally have seen a negative print in existing home prices on a 12-month basis. Here we have number of homes from Redfin for sale. We're down to our lowest level on record. You can see the down slope here, even going back to 2012. It's kind of an interesting data series, but we've had a noticeable drop off from even beginning of year levels here. Here's housing starts. You can see multifamily continues to trend upwardly, and the single family, which really kind of tailed off for a bit, has finally begun to pick back up, and you can see that in the homes under construction data, which is a slightly different data representation than what we're seeing here. Housing starts represents basically houses that are slated for construction that may not have already started yet, but have already been permitted. And I guess in some sense you see single family upticking here a little bit along with multifamily. You can see the general uptrend from 2010. And I think this chart will serve as a reminder that if you look at 2000 to 2005, we had a lot of units that had been started, and we went through a very long period of underdevelopment. And so now, just to remind everybody, we're still at a deficit in terms of supply and demand. There's more demand for housing than there is supply, and so that's why we have these starts data on a broad basis trending higher. Here we have the NAHB, National Association of Home Builders Housing Market Index. You can see that that is trending back up north. So it's just re-achieved its prior trend line going back to 2006 here. And this is, I guess, in many respects, it's good for the overall economy, because we know that owner's equivalent rent is a significant contributor to the inflation number. We'll talk about that in a second. I feel like maybe OER is not going to tick down as much or as quickly as we thought it was going to, but housing overall, and you think about all of the derivative spending, the home improvement, flooring, decking, wallboard, paint, all of the things that are tied to housing, to see this number uptick is actually good. And so you would look at this chart and say, okay, well, maybe housing is not going to be as bad. And if that's the case, then your theories on how deep a recession might be, will certainly be tempered. But this is data that we need to monitor closely. And again, you can see the underbuilding for many, many years coming out of the global financial crisis. And you can see these trend lines, the levels that we're at right now, and the home builders index are back to levels that we saw back in about 2015 or so. Here's the rate on a 30-year fixed mortgage. Again, fairly sticky here because we've had 10-year treasury rates that have kind of held steady, and so we're kind of in that 6.25 to 6 3/4 range for that 30-year fixed mortgage. Pretty consistent here over the last several months. Here's our recession probability. As we've been tracking this for many months now. You can see the spike, and we've come off that spike, but markets generally looking for about 35% probability of recession over the next 4 quarters here. And we have inflation overlaid with the Fed funds rate, and here you can see inflation coming off its peak at the same time that we're chasing it with increased interest rates. And so this kind of highlights, as you look at the very far right part of this chart, and you can see the positive relationship between these two data series, and obviously one is a cause and the other is an effect. But Fed funds the real issue right now is where does the Fed stop and hold and observe? Now, obviously, they paused in this last meeting. Market fully expects the Fed to raise rates at the July meeting, which to me, doesn't really make as much sense, because if you're motivated to raise them in July, why not do it in June? But that being said, here, the risk is that you've got, inflation, which is going to continue to trend down, maybe a little sluggishly, but then you've got short-term interest rates that are going to continue to move higher. And right now, there's I think the general data has us moving up about another 25 or 50 basis points by the end of the year. And then market is still expecting rates to come down towards the end of this year, beginning of next year, but I think that's way too early to call that right now. Core inflation, looking at it by region. Again, we have a synchronized inflation across the globe. We've been monitoring that. Some areas are handling it a little bit better than the rest. UK, we know, is experiencing really troublesome and meddlesome inflation right now, whereas most of the rest of the G7 is trending down. You can see overall G7 here moving slightly up, but you've got the Eurozone and the US moving down. Again, but they're at fairly sticky levels here. And so you see this number kind of flatlining a little bit. I think we showed this to you a couple weeks ago, but these represent core prices. And again, the notion that they're going to come down at a, at a more rapid rate, I think are going out the window. I think we're going to have to become accustomed to, higher rates for longer. But the issue is, if you begin to entrench that in the thinking, then that actually helps to beget more inflation. So this is, why all central banks need to be very cognizant of what the data is telling them, and not be afraid to try to fight inflation. I think, the Jerome Powell, our Fed chair, is fearful of becoming another Arthur Burns, who was our Fed chair before Paul Volcker took over. And Fed Chair Burns, back in the late 70s, was too timid on fighting the inflation that was clearly in front of him. And as a result, we wound up having even more inflation. And then that caused a fairly dramatic recession when Paul Volcker took over and clearly had to raise rates to fairly high levels. And so obviously we don't want to see that, but with inflation sticky here, you can't kind of like dance around it and just assume it's going to fall. And this is why I think it's reasonable to expect maybe a couple more rate increases by the Fed over the next several months. And then we'll just have to see what the data tells us. And the Fed is already making it clear that they're going to be data driven. And so, we'll have another inflation report before the Fed meets again. And that will tell us if we're making, how much progress we're making, basically. And I think it's, that type of data-driven mentality is likely to lead to more volatility in our investment markets. And here we have some labor data. You've got average hours by non-agricultural workers trending a little bit lower. So that on its face would tell you, if you've got workers that are getting less hours, this is, these are employers that are kind of preparing for an economic downturn. So they're, they're having their workers work less hours, but still keep them on the payroll, because that's the last thing that you want to do, is to trim workers when you don't have that, that negative economic data in front of you just quite yet. However, you look on the right side and you still see payrolls continuing to move higher, even though you do have these hours work going down. And so this is just symptomatic of a relatively strong labor market even still. So this is really, I think, the thing that confounds a lot of people, including the Fed right now, is you've had well over a year of rate hikes, but you see this labor market be pretty sticky up here. Now, a lot of these new jobs that are being created are in the service sector. We know that areas that were shut down during the pandemic, restaurants, hotels, bars, etc., that dropped a lot of workforce. Now those people are, have come back rather late to the party, and so a lot of these jobs created are not necessarily, white collar, high paying type jobs, but they're in the service sector. But still, it's levels of payroll growth that you would not deem consistent with pre-recession levels. We've got another couple of interesting business indicators here for you. This is new business applications here in the U.S. You can see that they have held up relatively well so far in 2023. Look at the trend post-pandemic, and it's been fairly consistent here at this 400 to 450,000 level. Here we have excess savings on the part of state and local governments. And so a lot of these jurisdictions received stimulus financing and have put it in their general fund or their permanent fund. And you can see that those holdings of U.S. Treasuries have spiked and still remain relatively high. So when you look at the health of state and local governments as it pertains to like municipal bonds and the ability to provide essential services, et cetera, that on balance, state and local governments are in pretty good shape. Here we have a couple of slides here coming up on the commodity basket. We see here on industrial metals that we're at a kind of an interesting support level, and you can see the last time we hit that on a couple of occasions there in July, August of last year, and then towards the beginning of November of last year, that it bounced off those levels and continued to trend a little bit higher. And so now we're back at those levels that we're kind of retesting, so it'll be interesting to see where we go from here. But needless to say, we've had industrial metals that have been a little challenge now. Again, some of it's the expectation of economic slowdown. Some of it's a slowdown, outright slowdown in commercial construction. But then you see overlaid with that is energy in the black line there. We know that energy prices have been a bit sluggish for about the last 9 to 10 months here. Here we have some of the agricultural commodities. You can see a little renewed spike. Corn, you see on the left-hand side, you've got winter wheat on the right-hand side. Both are spiking in a fairly stout way right now, and some of it has to do with drought conditions, etc. But it's not exclusive to that. Here we have the broader grain subindex here in the middle. You can see the 5-day rolling change below that. All of these ag-related numbers are looking a lot stronger than they had. So that is helping to fuel more commodity-led price gains. Now we're going to talk about the markets for a little bit. Here we have Uri and Timmer of Fidelity, and this whole notion of where are we in this market cycle? Have we established a new market cycle? I mean, we've crawled out of our lows and at one point established a new bull market, if you will, meaning that we're up 20% off the lows. And you can see this kind of spaghetti chart looking at other bear markets and how the index fared. Now, of course, we're in that black line there, and so we've accelerated beyond what these other trend lines would suggest. Now, I think what we're going to talk about, and we've got a fair amount of data on this, is that basically when you're off a new 52-week low and you establish another 52-week high, that generally the market's higher a year and a half after that. However, we also know that the market is very narrow. It's led by basically a handful of stocks. The broader index is not performing nearly as well as this chart would indicate. But it is important, as I've said already, to look at the data and to take stock in where we are. And so, this is, this is now driving the argument of, have we, are we even going to have more of a bear market, or is this a rally within a bear market which will then reverse, or is this the establishment of a new bull market which will put this bear market in the rearview mirror? And I'm not of the opinion necessarily that we're in a new bull market. I think we're going to have some adjustments, as I've already said, that in some of this economic data that'll be important to the Fed, and if there's any negative surprise in the coming months with regard to where the Fed is thinking, if they come out in August and say, we feel like, maybe the data is too strong, we're probably going to have to raise rates more. Well, the market's not going to like that. And I just think that we have more volatility ahead of us until we kind of get the markets settled in a little bit more. Here we have on the upper end of this chart the S&P 500 index overlaid with the 200-day moving average. And again, to the point that we've maybe gotten ahead of our skis here a little bit, you can see how that's tracked. We've kind of accelerated off of that 200-day moving average, and it's not unusual to see strong performance like this. What's interesting though is that usually have like an opposite corresponding effect with 10-year treasuries, and actually we have not seen that breakout at all there, and that's actually pretty interesting. And again, the correlation between these two is not terrific. It's not great, but it's just odd to see that we've had such a breakout in stocks, but we haven't really seen much gyration on the 10-year treasury side. See the S&P 500 index once again, but this is actually the S&P 500 divided by the 200-day moving average. And so you see we're about 1.1 now, and you can see how this oscillates. And this time series actually goes back to the 1970s. So it really does give us a wealth of information here. And you look at the dotted lines there, that represents recessionary periods. And, on its face, this data maybe isn't terribly suggestive as far as what the direction of the market from here might look like. But if you look down at the bottom, that's our yield curve, and basically our yield spread between short and long-term maturities. And we know that we have a negative sloping yield curve, and that means that short-term rates are higher than long-term rates. And you can see that very clearly defined here. We're actually quite negative on our yield curve right now, and you can see in prior periods where we have been at a negative yield curve, it has corresponded with recession. And so this is another reason why this data doesn't lie, and so we have to be respectful of what it's trying to tell us or trying to imply as far as future economic direction. Of course, then we've got to interpret how the market's going to react to that. But here, we've seen a kind of a breakout of the market at a time where we have this incredible, recessionary signal. But as we can see here in these little boxes here, it's not uncommon to have these kinds of rallies in the stock market when we've been either on the eve of a recession or in the middle of a recession, but maybe on the back end of it. But usually that does kind of stall at some point, and then you have more turbulence in the market. And so again, I just say we can celebrate the fact that the market's off its lows, but when you look at this data here, it kind of tells you that you're apt to see a little bit more turbulence ahead based on the slope of the yield curve. And this particular table here gives us some insight as to what the market might look like 12 months down the road after having witnessed both a 52-week low and a 52-week high subsequent to that within the same year, which is essentially where we are right now. And by and large, the market shows itself to be higher 12 months down the road. And I think this is fairly consistent with what we have kind of expected, especially if you're coming at it from the standpoint that we're going to have a mild recession at some point, and that's okay. But you could have some turbulence amidst that, or you could have a correction, just like we were looking at that last chart. I think a pullback is of some measure, maybe 5%, 5 to 10% is entirely reasonable to assume here over the next handful of months, given the strength that we've had. But this table would suggest then that at some point that we're going to have a higher market than we have now. And we have some more market data here. We've got the S&P 500 forward earnings yield less the 10-year Treasury yield. And so this is essentially taking earnings divided by the index price. It'd be the earnings composite for all S&P 500 constituents divided by the index value, essentially, and then you subtract from that the 10-year Treasury yield, and you can see here that that number has really fallen off, and like especially towards October, November of last year, we've been in this consistent free fall. And what this tells you right here is that the market is definitely overvalued relative to where bonds are trading. And I always give the bond market a lot more credit for kind of predicting and foreshadowing where the overall markets are going to go. And so at this point, again, more fuel to the argument that we're going to have a little bit of turbulence in equities coming up. Here we have a couple of items from FS Investments out of Philadelphia. Really good firm, great research. Here you have on the left-hand side, in that left bar, you've got the market cap for the S&P 500's top 10 constituents. And you can see here that's over $11 trillion. And just for perspective's sake, you can add in the market cap for the entire German, UK, France, and Japanese markets, and it gets you to about the same level, about $11.5 trillion. So just goes to show you how big and how ginormous these companies are that are leading the market this year. If you transition over to the right side, you can see here that the market concentration of those top stocks is extraordinarily high. Now you got to go back to really the 1960s. I mean, even back at the dot-com bubble, they were only about 25%. Now they're close to 30%. You got to go back a long time before we've seen a concentration that's been that heavy. At the same time here, we see the U.S. Treasury yield, the 10-year Treasury superimposed in the black here, where that has trended down. And so it's we're just at a very interesting juncture in the market with this concentration. And more work from FS Investments here. It shows you the free cash flow yield spread. And so this is just a measure of profitability and value. You can see here, and this is applied to the top 10 participants in the S&P 500 index, basically the 10 largest firms by market capitalization. And you can see here that on a free cash flow yield spread relative to the S&P 500 that we're actually negative. And so this tells you that the top 10 companies, even though we've seen some decent earnings growth out of these top 10 companies, it still is more expensive than where the market is. Here we have sentiment, and we know sentiment has really done a 180 in a fairly short period of time. And then you got to go back to really the Silicon Valley Bank issue and coming out of that, and the government basically making all depositors whole on this. And that was really the catalyst behind this whole, movement from these stocks that had this artificial intelligence tie-in. And then we have the sentiment number in the red here from the American Association of Individual Investors, the AAII sentiment number, and you can see how it's really shot higher. And it's almost kind of a reinforcing mechanism with the S&P. So S&P moves up, then sentiment moves higher, and you have all of these folks wanting to chase that caboose on the train that's pulling out of the station. And so as the market, as there's more retail investment into the market, then that just continues to reinforce the direction of the S&P 500. And in particular, the AA, when you talk about retail investors, they're going to be drawn to the headline stocks. So, the NVIDIAs and the Microsofts and the Apples that have really bolstered this economic or this market return this year. Those are the ones that these retail investors are jumping in. So it reinforces what's going on, and eventually, the music stops, and or maybe a better metaphor is a punch bowl gets pulled away, and that upward momentum just begins to stall out. But right now, it's still pretty strong. And something else which caught my attention this week with regard to valuations is here's a 6-month change in the NASDAQ 100 trailing price to earnings ratio. And again, very few points in time where we've seen such a dramatic move like this over the last 15 to 17 years. And we've had such a huge spike in technology firms' price to earnings ratios. We have a few more slides left. I thought this one was pretty interesting. So we've got China here. This is the consumer price index for China year over year. And, the article in the Wall Street Journal this week really highlighted, I think, the issue that China is facing. And we've alluded to this in some of our charts of the week over the last month or so about, this post-COVID reopening kind of unleashed a lot of activity for a fairly short period of time, and that activity is kind of peeled off a little bit. Now we actually have inflation that is almost negative. We're almost in a deflationary point for China right now. And that's obviously not what you want. And so, China being a leading component of the emerging market index, as well as overall global growth. And if you believe that China is going into a period of deflation, however long that might be, that certainly wouldn't get you really excited about overall global economic growth. And here we have some data from S&P Global Market Intelligence on credit. And, one thing I've been talking about a lot is the strength of the consumer being relatively uncanny. If you think you're ahead of a recession, you wouldn't expect consumer spending to be as strong as it has, but I think really the issue is how it's been supported is what we need to be focusing on. And so we do know that credit card balances, particularly by bank issuers, have really gone up, and as has overall lending from non-bank sources. But here we're focusing more strictly on credit cards issued by U.S. banks. And you can see here, and directionally is what I want to focus on, is that the consumer going into the pandemic was in relatively good shape, balance sheet wise, financial condition wise. Well, they've supported spending by increasing their card balances, and now we're really beginning to see how that's translating into credit card delinquencies, and you can see that is moving higher. And then you've got credit card delinquencies on the left, you've got credit card loans on the right. These are net charge-offs, NCOs, and you can see that they're all moving higher. And on this chart, kind of some interesting perspective to leave you with here today. And you look at this chart, it shows you the annualized returns in these various asset classes over almost the last 30 years, call it. So the S&P 500 here we see is about 9%. You see corporate bonds just slightly below 5%. And so that's really not too far off. They're much longer term averages if you go back to 1926. So we're in range with those two. And you see gold returning about 6 to 6.5%. in between both stocks and bonds. Again, not too inconsistent. And so, those are, really represent the bedrock of most investment portfolios. Then, of course, down at the bottom, you've got real estate growing at slightly less than 5%. And that represents, a lot of the things that we talk to our clients about that are invested in the markets or have rent homes, et cetera. But, what the top line here tells us, the post-war and contemporary art return of about 12.5%, what it tells us is that everything matters. And so we've got clients that not only own real estate, but they own artwork, they own antique cars, they own watches or collectibles and things like that. And my read through and all that is that everything matters, not just the assets that they have committed to the investment markets, but all of it. And it all has meaning. It all adds to diversification. It all adds to a return. And ultimately, it all adds to growth in wealth over time. So I will leave you with that thought. I hope you have a wonderful week, and we'll talk to you again soon. Take care.